What could a banking giant say that could possibly stun me into silence? Stay tuned because it might just change everything you thought you knew about the markets and the economy today. I'm your host, Steve Van Metre, and thanks for joining me today. And our show today, as someone who's seen it all, this email from Bank of America left me completely speechless. Trust me when I say you're not ready for this, but here's the best part. I'm going to show you how to profit from their latest report. Because this is our Sunday show where we transform raw market data into cold, hard cash. Today, we're diving deep into the latest technicals, momentum shifts, and machine positioning moves to supercharge your trading edge and your portfolio. Now, let's dive deep into this email and make you some money. As we turn to the Flow Show that's headed up by B of A investment strategist Michael Hartnett, says the big picture, the most important chart to watch is U.S. small caps right now. He notes there's been no breakout above his 2021 highs. That's a problem because with MAGA backdrop of tariffs, FDI inflows, tax cuts, deregulation, and Fed cuts, what he's saying is bonds outperform stocks. Is something not many people believe because a lot of U.S. investors are overweight equities and underweight on bonds. But let's talk about that chart that Hartnett says is the one to watch, and that's small caps. Here you can see that red line indicating the price is not broken out over its 2021 highs. In fact, since the election, small cap prices have reversed, and this is very important to understand because under President Trump's second term, many people believed that the U.S. economy was going to boom, and the big beneficiary was going to be small companies who generate most of their revenue domestically compared to large companies who generate revenue from all over the world. And so this is a red flag. If we continue to see small caps sell off, well, what it's indicating is the U.S. economy is headed lower. But there's something you don't know about the U.S. economy, and that's the labor market. Now, many of the experts say the labor market's strong and robust. Many of you have weighed in the comments saying, look, it's not that great. But here's the real issue. Since the pandemic, there's something that's been going on in the labor market that right now is suggesting we could head into a recession. Let's look at this chart because Hartnett notes that when you factor government plus education and health as a total percentage of payroll growth, you can see after the pandemic, government jobs have surged and now are looking to reverse as DOGE is making major cuts to not only the government spending habits, but its payrolls. And that risk now sending the U.S. economy into recession at one of the worst possible times. Because when you look at retail flows, here we see from their private client equity holdings that most of B of A's clients are overweight equities at the tune of 63% of their portfolio. But it's not that's the real issue. It's their cash holdings because many retail investors have been aggressively buying the dip, and what's happening now is they're running low on cash. And when you get to a major market peak, there's one thing that kind of resonates, and that is everyone that could buy has bought in. And what we're seeing now is that happening today. We're going to dig deeper into that narrative as Hartnett notes that 3.5% cash levels in B of A's February Global Fund Manager Survey, this being the lowest since 2010, shows investors positioned for risk on with limited buy the dip ammo. As Hartnett notes, a 3.5% cash level in B of A's February Global Fund Manager Survey, the lowest since 2010, shows investors are positioned for risk on with limited buy the dip ammo. And this is a huge risk for the markets today because when you look at what's happening, if there's any catalyst to send stock prices lower, what you see is retail investors and even professional investors such as these institutional fund managers, they don't have the cash to buy the dip. And next thing you know, you start to look at what causes major peaks in markets. What happens when everyone's all in and then someone has to sell. As we turn to Goldman, we find out who that seller is, and it is the machines. As equity CTAs over the next week, they are looking to be net sellers, even in a flat tape or an up tape. I'm going to show you why they're going to be selling in every instance over the next week. Now, over the next month, they could become buyers if the market goes up, but they're not going to be big buyers here. And again, I'm going to show you why on this next chart here, because it absolutely matters how the machines are positioned because they move hundreds of billions of dollars. And you can see on Thursday, we closed through this midterm level. And when you get a close above that orange line right there, that's the second level of support for machines. That triggers a sell position. Now, keep in mind, they can't unwind their whole book in a day. So you see the market came in the following day on Friday and drove it up, but the machines have already triggered a risk off move. They're going to be net sellers now going into next week. We're going to look at more of this from a technical position here in a bit, but you can see the risk off tone. And the issue here is, again, there is not money to keep buying these dips, and that's a major risk for the markets today. And here you can see US CTA positioning against the S&P 500. Now remember, these machines are trend followers. Here you can see them in blue. The market's gone down. That means they need to sell down. This is something we've been warning about. Even more importantly, we run a historical overlay against machine positioning, and we flagged this to our subscribers saying, look, it's very clear machines are going to be net sellers here. And who else is going to join that? Well, it turns out it's going to be retail investors, because they purchased equities for 28 straight days from January 10th to February 20th. That includes 4 of the top 5 largest retail imbalance days in history. And since then, they've had a net sell imbalance in 4 out of the last 5 days. So you can see why this note from Hartnett left me speechless, because what it's indicating is the payrolls that have been driving the U.S. economy for the last couple of years is about to come unwound. At the same time, everybody's all in this market. Now let's flip over and take a look at market breadth and how the markets are positioned, because I'm going to show you where you can make money and what places you need to get out of. And now let's start with the S&P 500. Let's look at breadth, and this is the percentage of stocks in the S&P that are above the 200-day moving average. Now remember, if you're below the 200-day, it's considered bearish. Right now, so just at 60%. You can see the trend lower here, and notably, you see a divergence. The S&P was rising, and I said, if breadth is following, price will follow, and sure enough, it did. Now, let's take a look at our screens here, because we know that momentum now on the S&P is negative. How do we know that? Well, we look for the RSI, and right now it's at 45. We want to see it under 40. We have a negative cross on the MACD, but when we look at momentum, we have a trend overlay, and that is our momentum timer pro, and is telling us that there are 6 consecutive daily sell signals. You can see that report right down here. But look at our machine positioning on our fast algorithm. It says a 55% short position on those. So you can see we modeled this. We know where machines are headed. And then the slow algorithm is only 35% long. Again, suggesting if we break back down near that midterm point, we're going to see more selling from the machines here. Now you'll note we don't have a position on the S&P right now, because we think there's better opportunities, and now the potential for a topping pattern to form here. Now, when you have a big surge in buying on Friday, what does that tell us? That Monday likely to head higher, possibly early into next week. We're looking at some very technically oversold positions. The MACD's got a massive negative cross here, but it's looking to bottom. The RSI is bouncing up. So again, technical traders came in here and bought this. Upside target is going to be right here at that 6-month volume profile, and that's where most shares have been traded, and you're going to see a lot of resistance there, particularly as we note there's been sellers in this market. But let's take a look at the tech stocks, and then we're getting into the small caps. I think there's a huge opportunity there, because when we look at the percentage of NASDAQ stocks above their 200-day moving average, well, they're only at 60% as well. And here you can see breadth went down, price went down as well. Let's take a look at the charts and our screens. What do we see? Momentum also negative on this. We see machines in short position here, looking to sell down, just as Goldman has noted. Our upside target is 513. Our downside target has been revised even lower since we hit that. But let's take a look at the chart of QQQ here, because again, if you're looking for opportunity in large caps, it's really not there. I think there's going to be a reflexive bounce into the 6-month volume profile, because it's coming off of some oversold territory here. There are people that buy oversold conditions, but there's one thing they miss, and that is the trend, my friend. If you don't have the trend behind you or moving with you, well, then these oversold positions are going to come and go in a very big flash. We're looking at a downside move right down to the 200-day moving average, but for the short term, I think early next week, we run right into resistance at that 6-month volume profile. Now let's talk about small caps, because if you want to see some opportunity from a tactical perspective, this is it. Now you see 44% of the Russell 2000 is above its 200-day moving average. That is a -2 standard deviation. Now you get down here and you start to see people that are going to be buyers and come in here and purchase the Russell 2000 in hopes that it turns around, because, well, a -2 standard deviation move is big. Let's take a look, because the RSI is negative at 35. MACD's also got a negative cross. The trend validating that. Momentum Timer Pro saying, look, we got 8 consecutive daily sell signals, and look at the short position on our machine positioning. You see our fast algorithm max short our long algorithm, it's getting down there almost at max short. So let's take a look at where we think the Russell 2000 is going and why perhaps if you're looking to buy equities, this is a place you ought to be looking at in a big way. And of course, we'll show you some other ones, but let's zoom out to this 1 year chart, because what I want you to see is this zone right here between these two purple lines. It's called a supply zone. How do you know it? Because it's when people have bought every time the Russell 2000s got down here recently. And what happens? Every time the buyers step in, they push price up. Now we can see the 1 year volume profile as sellers dominated from this zone up here, coming down into a buy zone. It's technically oversold. And if you start to see price bottom out here, look for again a move back up to 221.26. But don't hold your breath. If that doesn't hold, you're looking at what could be a fantastic topping pattern. But for the short term, could be a great trade if you must buy equities. But let's talk about the energy markets as we look at some of these headlines. As WTI jumps to 70 as U.S. sanctions rekindle supply concerns. Of course, when you hear supply concerns from a trading perspective, you think, wow, that can make some money on that. But when you look at the chart, it gives you an entirely different perspective. Let's take a look at XLE here. What do we see? Momentum is positive. We've got an RSI above 40. That's at 53. MACD's got a negative cross, but Momentum Timer Pro says, look, the trend and technicals are moving in the right direction here. Our upside target and downside targets are unchanged from last week, and machine positioning somewhat neutral on the fast algorithm. The slow algorithm still hasn't sold off yet. We're coming off a sell max on this 1 month window, and from a price perspective, it makes things interesting when you take a look at momentum. And what do we see on this 1 year chart? The prices are right where they've been over the last year. And this is where people have been buying and selling. This is the battleground right here. What's that telling you? There's no opportunity. Don't touch the energy sector. Perhaps you should look at financials. Let's head over to this headline as bank stocks are set to do pretty well under Trump 2.0. Now let's talk about that, because what would drive bank stocks higher? Well, it's higher interest rates and inflation. But guess what? That narrative's changing in a big way. Here we see RSI at 62. MACD's got a negative cross. So what we're seeing is potentially peak in momentum. But Momentum Timer Pro says, hey, look, the trend's been up now after several days of sell signals. Upside target. This thing can break to new all-time highs because there's machines that could be buying into the financials here. Downside target at 50.15. Let's flip over to the charts. Take a look at financials and see if there's any opportunity. And well, if you want to buy near the all-time highs and hope it goes higher, there's your chance here. You're seeing a little bit of change in momentum, but nothing too strong. Nothing that would tell me that this is a screaming buy. If you're looking for a screaming buy, there's other opportunities, because one thing we made money on and got in and out of that was Brazil. Now you can see foreigners are selling, but we cashed in big. We made 6.57% on that trade. Now you might be wondering, how did we do that? Well, it was really simple. We put our trade on when the thing was bottoming and turning higher. We let it right up. We raised our risk control levels or stop loss. We let it stop out. We cashed in, and now we're moving on to other trades. You want to know how to do that? Jump on those reports, hit the links in the description below, grab those 30-day free trials, because right now investors are scouring emerging markets looking for Trump-proof bets. Well, if you want a Trump-proof bet, I'll show you the one you really should look at. But let's say what the pros are doing. They're focused on emerging markets. What do we see with the RSIs at 45? MACD, negative cross trend to the downside on top of it. Momentum Timer Pro saying, look, this isn't your opportunity. How about machine positioning? It's fairly long, looking to unwind. Let's take a look at the chart for EEM here, because again, I don't see opportunity in this chart, but I want you to take a look. And if we zoom out to the 1 year, what do you see? Price went up. It jumped after the election, it pulled back, and now it's just trying to go higher. And then look, massive selling last week, holding support right. It's a 50-day moving average. There's the 1 year volume profile. If you start to zoom out a little bit further, you lose confidence in this chart, because you start to realize that yes, the trend needs to go higher. And if it does, you need price to hold here. If it doesn't, what you're risking now is a further sell down in emerging markets. You can see from the long-term chart, momentum on the R side of the downside. MACD's got that negative cross. Things are changing here in a big way. But B of A noted that the opportunity wasn't in those sectors. It was in bonds. As Harton says, buy U.S. long bonds. Trump won't go big on tariffs as political malpractice to allow a second wave of inflation. Meanwhile, Doge is cutting money in a big way. Let's take a look at TLT here. What we see, momentum is positive. Their size is 67, pushing near overbought territory. MACD's got a big, beautiful positive cross. Momentum Time Bros got 8 consecutive daily buy signals, and we told our subscribers to buy back on January 31st. This trade now up for them. You'll note that we have still a broad position that's down slightly. Again, we are trading this one without a stop loss to show you how to not trade without risk. And again, once we get into a position, we'll put stop losses back on that trade. But let's take a look at the charts here for TLT, because you want to see some opportunity where nobody's looking. You can see it very clearly. You got the 6-month volume profile acting as support. We told our subscribers to buy back here on the 31st. That was way down in here, and now they're riding this high. We think resistance is going to be right up here in the supply zone. How do we know it? Because, well, you can see sellers were up here before. They're going to push back a little bit. You've got some underlying support of the 100-day moving average. So we think there'll be a rally up. Sellers will emerge. There'll be a pushback. If that holds, look for another big move all the way up here to around 100. This could be the next big trade on our books. Don't want you to miss out on that one. Now let's talk about gold, because remember, Goldman says target 3,100. Will it get there? Who knows? But let's talk about momentum. Right now, it's shifted to the downside. Remember, we said if you want to buy gold, buy the mining stocks, because our subscribers cashed in big. We told them where to buy. We told them where to raise their risk control levels or the stop loss levels up, and we let the markets do the rest of the work. They walked out of that trade with money in their pocket. Let's talk about another trade they made money on. That is wheat. We locked in a 4.67% return for Momentum Timer Pro subscribers. We did the same way. We told them exactly when to buy. We raised their stop loss levels as price went up, and they got stopped out, put that money in their pocket. But everybody's talking about the dollar now. It could go higher. Let's take a quick look to see what's going on with the dollars. Momentum here is negative. The RSI is at 53. MACD's got a positive cross. But look at this, the trend isn't validating that. Momentum Time Pro says, look, forget the technicals. You've got to have the trend with it. 18 consecutive daily sell signals on a 1-month window with the sell max. You see machines buying a bit of the dollar here, but is this a dollar bullish trend? Well, let's take a look at the charts here and see what we find for the dollar. And it simply tells us something that isn't as great as it might appear, because when you look at this chart, what do you see? The 6-month volume profile is acting both as support and resistance. You can see it's coming off some fairly oversold levels from the MACD and the RSI, looking to say momentum's going to push higher. But there's a problem. When you get a cross below the 50-day moving average, which you see here in green, then it rolls over. This is a bearish sign. So if the dollar rallies into the 50-day and gets rejected, well, that is a bearish indicator. So this is one symbol I would say is not a buy, but what we learned from Bank of America, we see the pros looking to emerging markets. We see a potential reflective bounce here in the major large caps, but the opportunity could be in the short term. For the small caps, the longer term, look to the bond market as well. That's at least what Bank of America says, and we completely agree. Of course, we'll find more trades as they show up for you and bring them to you each and every Sunday. Of course, our subscribers get that first. You need to jump on those reports to get those signals, because again, we're turning market swings into cold hard cash each and every week, putting money in your pocket. With that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.